This type of bloodbath market, there's only really three solutions to the problem. You either sell everything, you go into cash and you wait for better days to come, or second, you become a trader and you trade with whatever's hot at the moment, which would be the green spot here. Or third option, you remain an investor, you stay course, you focus on quality companies and you keep buying them. And obviously here on this channel, we are in the third options. We are the long-term investors. So we're always looking for the best opportunities at the moment for the long term. So today we're going to talk about 3 growth stocks to buy at the moment at really low prices. All three of them have great growth stories ahead of them. They're all 3 in different types of industries. They play in the fintech space, in the telehealth space, but also in the crypto space. So stay tuned for that. Hi, my name is Robert. Welcome to the channel. Here we always look at things from an unbiased perspective, look at pros and cons of all the stocks that we identify. If you like this content, please consider subscribing to the channel and liking the video. But let's get into it. The first stock we're going to talk about today is Sofi Technologies, ticker symbol SOFI. The dollar amount here trading at $9.72, which is below their initial spec IPO price of $10. And the market cap here equals $7.77 billion. At the moment, is this really trading at a cheap valuation compared to what they've been trading at even when they were still a private company, which was estimated to be around $10 to $13 per share based on their stock options that I've looked into. So even back then, which was a couple of years ago, they traded for a richer valuation than now, although they've made a lot of progress in the meantime, as we've seen from their recent Q4 earnings. Lots of revenue growth there, over 50%, strong gross margin as well. But most importantly, they had been granted their bank charter during the year, which the effect of that we're only going to see from May onwards, from May this year. So what that means is that they can operate as a bank, meaning they get access to cheaper money and are therefore able to increase their gross margin, increase their EBITDA margins, but also obviously to provide customers with better offers, provide them with better saving interest on their savings accounts, but also with better interest rates on their personal home loans and so on. And SoFi, the big moat here is that they want to be in one-stop super app for all your finance and banking needs. So basically a futuristic bank that is only online, no branches, no nothing, just an app for all your daily banking, investing and loan needs. So student loans, home loans, car loans and so on, but also investing in stocks and crypto and obviously savings account, which because they are such a lean business model, they can afford to offer you better interest rates on their savings accounts as well. So really exciting stock here for the future. Obviously being hammered as they were just considered as a high growth play that is still operating at a loss. So we've seen a few spikes on the way because they obviously had a lot of hype around them. Now that hype really came down, trading at below their initial price, which I do think is a fair price, below 10 price to sales ratio at the moment, which for a company that grows more than 50% revenue year on year is considered to be pretty cheap, I think, and with also the potential of doubling your EBITDA from the gaining of the banking charter, obviously will help them as well to further get that multiple down further, as well as they grow the revenue, but also their margin going forward. That will help that the multiple that it's shown right now, that you see right now, to actually suppress that and get that lower in the future years. And then one risk factor with Sofi Technologies is obviously the share-based compensation, which I do think I'm gonna make a separate video about, and just gonna do a deep dive on that, because it is almost a 30% of the revenue shown for the Q4. They had a share-based expense there, which was actually divided into 3 bits and pieces, which is not just share-based compensation as stock options, but also performance units that are linked to performance goals and such, and other stock options granted. The next stock, of course, is HIMS and Hers Health, ticker symbol HIMS, trading at $4.29, which is also, as they also IPO'd via SPAC a year ago, roughly, is also below their SPAC price, which was also at $10, had an initial spike all the way up to $19, and now down to $4.3. So I hope you didn't buy into this when it was $19 and super hyped, because at the moment, yeah, obviously you would have lost 80-90% of your money. Now trading at a really favorable price. If you look at what the company is doing, revenue growth really impressive, over 80% revenue growth as such, gross margin at around over 70 to 80%, which is also very healthy. As more customers as they get onto their platform, they are generating a better margin and obviously retaining those customers that they already have due to their subscription model. So they are a telehealth company that via an app you can basically get a consultations with a doctor or a specialist for your needs, which are mostly tailored to sort of sexual health, hair loss, and skincare products or skincare issues, so to say. You will consult with an expert on that, and then they will subscribe you with products that relate to that. And this is where the margin comes in, because obviously once you get that service, that one-off consultation, and you decide to go for the products, then you have a recurring subscription there, which the company makes most money off. Then they just only have to acquire you once while you remain on the platform and keep money keeps going in, whilst they're getting new customers on top of that, so that the overall marketing spend that they have at the moment over time will be lower as they acquire more and more customers, which will be retained on the platform. So this is why this is a pretty good business model as such, because obviously you have the subscription model, but you also have the telehealth solution, which is the future of healthcare. As there's other companies like Teladoc out there who's very big in that space. But this is very a niche player targeted at more the millennial and Gen Z, so the younger generations that are very comfortable of providing or getting healthcare via an app or a phone as such. So they have really obviously a great future ahead of them. They're only a few years old, only 4 years old, and I do think at these price levels there's not much you can do wrong with it. I mean, given the revenue growth and given that we are really expecting the gross margin to stay consistent, customer acquisition to come down. Retention rate is around 80%, so that is a proper retention rate from their subscription. So as they add more customers, they obviously increase their revenue, and if they keep the marketing and other operating expenses at those levels, then we will see eventually them being profitable, which they are not at the moment. And by the way, all the companies we're seeing here today, they have limited to no debt on their balance sheet. They're all equity funded, which means low risk in this environment that interest rates are going to go up or they're going to go bankrupt because they're not profitable. None of them will have any issues with that as such, and that's why also I chose them here today. And the third one is a new one that I haven't spoken on this channel yet, but I want to get into it in more detail because I think that's one of the most exciting opportunities out of those three. I would call it, that's the top one. HIMS is the top two, and Sofi is the top three for me in terms of the opportunity for the long term. So this is stock that we're talking about now is Voyager Digital, which trades as an OTC stock in the US under the ticker symbol VYGVF. That's a ton breaker right there, and also trades, originally it's a Canadian company, so trades on the Toronto Exchange under a different ticker symbol. But if you just look for Voyager Digital, that's important because there's other Voyager companies out there, so it needs to be Voyager Digital. They're a cryptocurrency brokerage firm. They have an app where you can buy, trade cryptocurrencies, stake them to earn rewards. So they've been really being popular because they have a lot of coins available, many more than other platforms such as Coinbase or Binance. So the number of coins they have available is really large. And also the earnings on the rewards, the percentages that you can earn there, they're also really attractive. So this is why a lot of people moved over to that platform, because they could actually earn much more with their Ethereum and Bitcoin, but they could also trade other coins that are not as popular for now. And that's why this has become a popular app. And similar to the other ones, it's quite new still. So we've seen that it became a public company in around April last year, and they're really a new company as well. So they're pretty much listed straight away, which is similar to HIMS as such, because we basically get an opportunity here to take part of a venture capitalist type company where we're very much in the beginning of the company, we're at the beginning of that growth space, which we do have to pay a price for it, and which you can see here is obviously the volatility of the stock. So because it's such a new company and all these companies are quite new, volatility is higher because they're considered more speculative, because they're not as proven as a Coca-Cola or an Amazon or something like that. This is where the opportunity comes from, in my opinion. And this here today trades at a $1 billion market cap only, has been trading now at $6, and we had highs of $22 and even a $30 range here. So the 52-week range is really impressive and extraordinary for this stock. So we had a few deals, such as with the Dallas Mavericks coming out. We have lots of partnerships in the sport business, but also in terms of just purely the valuation and the rate at which the company grows, over 100% revenue growth. So you can see that in 2020, they only had a few $1 million of revenue. In 2021, they have now over 416 million revenue trailing 12 months here, which is just impressive growth. Obviously, the margins are also good, but at the moment, we still have a lot of marketing expense, similar to HIMS, where the marketing expense is very high. So we do have a similar issue here, whereas at Sofi, for instance, it's not really the marketing expense as such, it's more the share-based compensation that is a worry there. So for HIMS and for Voyager, it is the marketing expense, as they are such unknown companies for now and they need to expand and get known by the broader market. They do have to spend more money, obviously. But in terms of the valuation, this is really ridiculous. We have a price to sales of under $3, and it's just trading at a very, very cheap valuation if you compare it to something like a Coinbase or a Binance, or even also like an FTX, which is privately listed, which is actually a similar size to Voyager, has a bit more members than Voyager. Voyager is around 1 million, and FTX has a bit more. They're trading at a multiple of Voyager, and this is actually an interesting topic which I want to make a video about. But just to see the difference between the private market and the public market is impressive, and the valuation here is very cheap at these levels, as obviously crypto has taken a hit from Bitcoin being at over 60,000, now at around a $40,000 per coin. And Voyager goes basically, it's almost like a commodity type stock where if the price of Bitcoin goes up, Voyager goes up. If price of Bitcoin goes down, Voyager goes down. But you have to look at the underlying fundamentals of the business. And also the CEO mentioned in another call that I listened to that actually when Bitcoin goes down, that's when they see increased enhanced activity on their platforms. Those cryptocurrencies, those crypto brokerages, they always go down on those news. But actually, in fact, they're making more revenue on those days as people go in, buy the dips, sell, trade. So whenever there's a trade, whether it's selling or buying, they make some little amount of money per each trade. So that means increased volatility is what makes them earning the most money. So this is an interesting one to look at. Definitely keep your eye out on that one. Okay guys, that's it for today. I hope you liked this. Let me know in the comments below if you buy in any of those. I mean, I know a lot of you guys are into HIMS, of course, but let me know if you're buying any of these other twos. See you next time.